and welcome to this week's look back at the major stories to have affected the markets so far. And there's one place to start, and that's off the back of last week, the FTSE 100, and we were talking about that magical, mythical 8,000 level. However, was that a pipe dream, or at least for now? Last couple of days haven't been so rosy. We closed last week at 8,004.36, that famed closer rate over 8,000 that everybody wanted to see. This week's not been so great. In fact, we've eased off slightly. The market currently around the 79, 79, 20 mark. Now, not a massive surprise. It's been tough conditions over the last couple of years. Lockdowns and the inevitable effect on the economy, the cost of living crisis, the geopolitical concerns, and interest rates and inflation going through the roof. And despite all of that, the FTSE 100 has performed well comparatively to other asset classes and even other indices. So again, last week all the talk was about 8,000. Well, what's happened? Well, we've seen smallish drops each day. That's despite better than expected news on public sector debt, for example, and the overall health, I use that term loosely, of the UK economy. There's been no major negatives in terms of figures coming out. And in fact, if we look at today, Rolls-Royce brought out some lovely figures, and they're doing particularly well as one of the constituents. They've beaten profits like many of the other FTSE 100 listed companies. So is this just a short-term blip? Well, it's worth noting that, say, actually quite a few of the companies and major players in that FTSE 100 have gone ex-div, which means those dividends are reflected, that are paid out, are reflected in the price of the stock. So that may be having some effect today. Probably not that for the last couple of days. Lots of figures coming out at the moment today, over the next week or so. So what's going to happen? Well, this could just be a period of consolidation and hopefully we'll push back over the 8,000 mark. But it's certainly something worth keeping your eyes on. Okay, for our second story, we're going to stay in the UK. I'm going to take a look at the Great British Pound and the fact that earlier this week it had a sudden jump versus the euro and the dollar in what was effectively a bit of a surprise revival. Now, we've been speaking recently, obviously, about its performance, its doldrums back end of last year and how it's recovered well. But Tuesday afternoon, after a bit of a slack period, we saw a quick jump up to almost 1.22. That wasn't a huge jump from its low area in the day of 1.21, but it's important because it was the highest point for 5 days. And we saw sterling against the euro rise to 1.137. But why was that? And in fact, we've actually eased back a little bit now. Now, could it be due to the better than expected consumer demand figures that came out earlier in the week? In fact, that's leading people to think of better growth. Did that have a short-term impact? All of this is despite obviously much higher levels of inflation compared to somewhere like the US, and obviously we've seen continued dollar strength because of that, and growth. You know, the US has recovered a lot quicker than we have in the UK. So on top of this, we've got the Fed's hawkish stance still in play based on the minutes that we'll talk about shortly. And so it does seem to be less belief of interest rates and inflation rates peaking. We've talked about this quite a bit, and certainly market commentators previously were thinking, we could be seeing the end of these horrifically high levels of inflation and interest rates may not go as far as we thought they were. That thinking's been reversed a little bit. It has eased back down. We're currently around the 1.202 mark. It does seem to be defending 120 level so far. On top of that, we've got the Northern Ireland Protocol in play at the moment, which is having some effect on the UK markets, and that's to do with the trade barriers between the UK and the EU, specifically in Ireland. We also think that a lot of big figures come out of the US and the UK in the coming days, particularly this afternoon, so they may well be holding volumes back slightly, which of course does have an effect on the price. But as I say, we do seem to be defending 1.20 so far. So aren't we about to see another resurgence in the pound, or will we see those levels ease off? Volatility is pretty much back in the markets, and don't forget your risk management techniques. Now we're going to take a look at the minutes of the Federal Reserve meeting that took place last week. I did say last week in the video, obviously they came out with a 25 basis point rise, but the minutes would be looked at to see what people were saying. Now, 25 basis points, 0.25%, was agreed by almost all members, and is pretty much in line with what the market expected. The stock market fairly flat off the news. There was a small sell-off, but nothing too major. And the markets took the news, though, that some did not vote for 25 basis points. there's a bit of concern. They wanted a 50 basis points rise, and the minutes have sort of proven that. Some of the members of the Fed were keen to keep to 50 basis points because they felt it was the best way to try and beat inflation. We are definitely still looking at further interest rate hikes through the coming months, though the speed and size of these is now what's being discussed more than whether they will or won't happen. The Fed have come out and said the labour market is still, as they like to call it, hot in the US, so they're not too worried about the concern of interest rates increases in inflation on that labour market as it stands. Let's have a look at what this means for the dollar index. Well, the futures are up, no doubt about it. And looking at the chart, what can we see? Well, there's more moves away from the descending channel, which is in red, which was relevant for about 3 months. Now, there may be growth towards the key level of 105.5. Perhaps that's more likely than it was previously based off what's happened. Nobody obviously can tell you for sure. But the arrows do show that the repeated trend reversals, which again may indicate a rise in that dollar index. US GDP and initial jobless out Thursday today as well, and those could become and probably will become key drivers for the dollar index and overall, to be fair, probably the US economy as a whole. So I'd take a look at those figures, factor them in to your trading for the coming days and weeks. Finally, we're going to swap markets. We're going to have a look at a commodity and we're going to have a look at oil. And that oil volatility seems to be back in vogue. The prices are becoming more volatile. We've seen a huge price increases during 2022 for a multitude of factors. We all know about geopolitical concerns, supply chain issues in terms of COVID, lockdowns, etc., etc. So 2022 did mark a substantial rise, and then prices not really fluctuating too much. We saw them stabilise for quite some time. End of last week, Brent crude was heading towards $80 a barrel. There was a lot of talk about production, which I'll come on to in a moment. But Friday, it suddenly crashed down to $75. Monday, early hours, it headed back up to circa $78. What's going on? What's driving this behind the scenes? Well, let's talk about cuts in production of 500,000 barrels a day in March by Russian producers in response to the Western price caps. Now, that's not really a surprise. They're putting a cap of $45 per barrel on Russian-produced oil, but market price for everybody else's oil. Do we think Russian producers were going to entertain that? Well, probably not. That is on top, of course, of, if we go back to last October, I think it was OPEC Plus countries saying they would cut oil production targets by 2 million barrels per day until the end of 2023. And as usual, we would suggest that, reduced production would equal increased prices. And the last couple of days have seen some sharpish moves. And actually, there's a bit of conflicting information about the market at the moment. US inventories are up, and they've been doing that pretty much on a weekly basis for some time now. And that sort of negated the impact of this Russian reduction in production. We've talked about the Fed, we've talked about the minutes. There are concerns that hawkish policy could affect the level of demand. Now, that would, of course, mean if demand's going to decrease, potentially prices go down. Wednesday, in fact, saw the biggest one-day loss for 7 days in Brent crude off of some of that information. So we've got conflicting information about conflicting concerns. Are oil reserves in states going up? Is production going to be cut? Is demand going to decrease? We've seen record levels of demand recently, but that could be changed by government's hawkish stances. But there's one thing for sure: conflicting information equals volatility. And I think we're going to see more volatility in the coming weeks in the oil market than we have done for some time. We wish you luck with your trading in the week ahead. Bye for now.